All right, we are live. So, welcome to the Wednesday Zoom and Learn. And today it's everything taxes, right? We're going to talk everything about taxes from start to finish. So, take good notes. If you want a copy of the deck, Annie or myself can send that out to you via email. Just let us know. And we will record this as well so you could go back and listen to it again afterwards. But we're going to jump right into it today. We're not even going to mess around. Let me share my screen, Annie. And all right, let's
Everybody see that okay?
I may have to move that, but I will move it so that everybody can see it. And Annie, I'll let you kick it off. Let's talk real estate taxes.
All right. Okay. So basically, the year runs from July 1st to June 30th. So July 1st is the first day of the tax year. It's not January to January. It's July 1st to June 30th. Most of your sellers and buyers are not going to know that, so you might want to make sure they are aware. Also, the first installment of the tax is due. It's due November 1st. It's delinquent December 10th. The bills usually come out about a month before. So starting around the end of September, 1st of October, that's when the bills will start coming out for that November 1st due date, okay? They actually do have a time cutoff. So in other words, if you pay it after 5 p.m. on December 10th, then it will be delinquent. So it needs to be there by December 10th, 5 p.m. so that you don't have the delinquency fee. The second installment is due February 1st, delinquent April 10th, and also it's 5 p.m. So that's basically the taxes and when they're due. Now, let's talk a little bit about when they become a lien and when they actually become tax defaulted. So if July 1st is the first day, then, and you don't make the payment all the way through to December for the first half, January 1st, the taxes become a lien on the taxable property. They become a lien at 12:01 a.m. That's January 1st of the following year. So you're in July 1st of, let's say, 2020, then it wouldn't become a tax lien until January 1st of 2021. So it's the following year. Then if you don't make the payment by June 30th, then they consider the taxes to become tax defaulted. So for any non-payment of taxes, you're now in default. What does that mean? It means you pay more. So now you're not going to just pay the 10% or the 10% plus $10 penalty. You're now going to have to start paying interest on top of that, the penalty interest. Okay, so that's when that changes every month from that point on. As everybody knows, I'm sure everybody knows, for residential property, they won't actually, you can't actually bid on it or start, purchasing them until after 5 years. You have to be in default for 5 years for residential. I don't know if you knew though, for non-residential commercial, it's only 3 years. So I wanted to make sure that everybody was aware of that. It's 3 years for non-residential commercial and 5 years for residential.
Say that one again, Annie.
So if you are 5 years delinquent, 5 years in a row delinquent on your taxes, that is when they will actually start putting it on the auction. So in other words, people can start bidding on it so that you can actually lose your property after that time period. Mm-hmm. That's for residential property. Okay, I think everybody knows that because we're all talking about it all the time, but I wasn't aware. At least I wasn't aware. So I don't know if you out there are aware. Non-residential commercial property is actually only after 3 years. Okay, so if they're 3 years in a row, you will start seeing those show up in the auction so that they can bid on them.
Now, can somebody go down and try and take a property over without it going to auction if it's, say, gotten to that 5-year delinquent or 3-year?
That's going to be.
I heard of something where somebody went down and paid the taxes and then continuously maintain the taxes under their name, and then after a certain duration, they're able to take it over.
Well, that's a possibility if you go down to the tax assessor's office. There's a bunch of forms though that you have to fill out to do that.
Right.
So what you're doing is you're just bypassing the auction, and I'm pretty sure that you, just like anything else, you're going to go down, you're going to fill the forms out, you're going to take that chance if you do this, and then it's going to get published again that you have done this, because that's usually the way the tax assessor works, is they publish it.
I've heard of that being done so that it didn't hit auction and then have multiple, bidders coming in to try and buy it.
Yeah,
right?
I think people do
It
that
before it happens, goes to auction so that they can swoop it up.
Yeah,
right?
just get in there and start doing it. Yeah, that
a
does
lot of times these tax. I mean, think about it, like 3 years, 5 years, even 5 years. There are some properties out there where that could be ultimately about 10,000 in taxes.
Right, or more actually, because
right. But it could be. I've seen them as low as 10,000.
Right, that's true.
So, I mean, you can find a defaulted tax lien type of purchase usually between like 10 and 100,000.
Yeah, and you're talking California. If you look at other states, it can be less than that.
Yeah, depending on how long they owned it, right?
Right.
So, okay, cool. Thank you.
Okay, so let's talk about special assessments, because I get a lot of calls on these, especially the Mello-Roos. First of all, does everybody know what Mello-Roos is? I printed it out here for you, but Mello-Roos basically is a special tax that circumvents the Prop 13, which of course I'm sure you all know that limits the property taxes from being increased until you actually sell the property. So because of that, they created Mello-Roos to allow for a special tax to be assessed for repayment of bonds and things like that, funds that were used for infrastructure in their community. So that's what that is. It's basically a way of going ahead and getting that extra tax on there, because you can't just up at any time you want.
Yeah, Mello-Roos is actually a assessment tax driven to the homeowners. It's funny because Mello-Roos was named after two gentlemen, Mr. Mello and Mr. Roos.
That's right, yes.
And they were land developers, and they didn't want to pay. They wanted the city to pay for certain infrastructures, and they didn't want to have to pay for them. The city said no. So therefore, they pitched to the city or into the counties that they will bill it to the homeowners as an additional assessment tax.
Mm-hmm.
And it went to a vote. So all they had to do was post it out there that there was going to be a meeting for a live vote. And so they posted it, but nobody advertised it and nobody showed up. So Mello and Roos both voted one way and they got it passed, right?
Yeah.
That's literally what happened. And then it basically allowed them to get grants from those cities, and those grants are paid back by the homeowners over a duration of 20 to 40 years.
Mm-hmm. Yeah. That is that's how it was first created, but now it's actually, they're using it for other things now.
Yep.
So they opened it up. Now, Tommy, this is where I was hoping that maybe you could show them how they can actually look on where these special assessments are. So if you don't mind, can you bring up your page and we can go to the property tax section?
Because, in the CRMLS and stuff, they changed realist. Yeah. So realist tax is not allowing you to pull up the tax sheet or the special assessments anymore. They're just giving you total taxes. So I get a lot of calls now on special assessments. So let me stop sharing real quick. And give me 1 second here to prep it. Okay.
Guys, I think you get so much noise because a lot of people are not muted.
Yeah, I'll mute everybody. Okay, there we go. So let me share. All right, so from my site, let me go back here. From my site, which is Tommy for Title, T-O-M-M-Y, the number 4 title, you can go to properties, you can log in, search a property. I'm just going to search any property by, put smart search on. And let's go like, brought up Daryl's old address, 3206. All right, so say I wanted to search this property.
All right, let's see what the taxes show.
I can come down and create a property tax report, okay? It allows you to put in a sales price. So whatever the sales price is, you put that in, it'll do the calculations for the new tax, right? I'm guessing, I don't even know this property, but we'll just create one and see what it shows. And then it will bring up your tax sheet, right? So it gives you all your pertinent personal information on the property up here. And then the estimated new tax is right here based on that sales price of $585. And then it gives you your special assessments. Well, the basic levy right here is the Prop 13 base tax on the property, which is your 1.13, certain percent. Everything else from here down are special assessments, okay? So you'll see these CFDs, Community Facilities Districts. Sometimes they're abbreviated CFD. These are kind of like what Mello-Roos used to be, right? Now it's a special assessment. It's a Community Facilities District assessment. This is a bond. These typically will expire. Yet I have found some that never expire. They're ongoing. Very few. I will give you a little hint of looking this up. If you take this Community Facilities District right here and you just copy this, right? Take this whole thing right here and copy it. Go plug it into Google. You can usually find the CFD document that is on file. And in that document will tell you when it expires. If you can't find it, the only way to find out on that if it expires is you have to call the county or call the city. You have to tell them who you are and say, I'm looking in to find out who manages a certain special assessment or a CFD. They'll ask for the fund number. The fund number is right over here, right, on this side. So they'll ask for this 6-digit fund number. So you'll give them 682726. And they're going to give you an 800 number to the company that manages that fund. You'll then call that company. You'll always get an answer machine, so don't be discouraged. But they do call back within like 24 hours. And you will leave your name, your phone number, who you are, the fund number, and you'll leave all this information here. And you will leave the information on the property, the address, and the APN number, okay? And you will tell them, I want to know when this CFD expires. And they'll call you back and say it expires the second half of tax season 2041 or whatever it is, right? So they'll tell you when the last tax is on it. Now, that's when it is scheduled to expire now, but that can change. If there are a lot of delinquent taxes or people moving and taxes aren't being paid on time and things like that, that prolongs it because it's a certain dollar amount that has to be paid back, right? And this dollar amount never changes. It stays that for the entire duration. So that's how you can find out when that expires, okay? Sometimes there's 2 or 3 of them on a property and, they're managed by 3 different companies, right? There's a company out there that manages that bond. It's not done by the city. So sometimes you may have to call 2 or 3 different companies to find out when those expire, okay? I get the question usually on houses that are 20 years old or coming up on 20 years old now, because basically anything after 2002, you'll see either some Mello-Roos or Community Facilities District on there. So a lot of times I'm getting them and the house is 15, 16, 18 years old and they're wanting to know when it'll expire. And then they find out there's another 20 years, right? So just for reference, when you see those in red, most of those will expire eventually. But I don't find too many that are 20 years. I find a lot that are 30 and 40 years on the bond, okay? And then you can email the report to yourself. You can print it. You can save it as a PDF, okay? And that's it, man. Real simple. You know, I know right now people are complaining back to the CRMLS that, you know, they want access to special assessments within Realist again, because once they did the update, they went away. We don't know if they'll come back or not, but this is your alternative right here, is you can get them through me.
Right, and if you don't have access to get to Tommy's, then please contact myself at Granite Escrow. You can call my cell 619-787-5172, and I can take care of you that way. So just either one of us, please get a hold of us if you have any questions regarding that.
Or you can register on my site. It's Tommy4title.com.
Yeah. So let's talk about PACE and HERO. That's another thing that we hear a lot about. So the HERO is obviously, that's like the energy. You can see, you'll see it. It's an energy, basically a financing company that it's America's financing company that you can get, and it will actually cover solar. We've seen solar. We've seen different types of energy.
Windows, solar,
doors, just all different types of things.
Air conditioning and heating.
Yep, that's true too. Yep. And so HERO is a form. It's a PACE provider. PACE is just a financing issue. It just stands for Property Assessed. What does it stand for? Property Assessed Clean Energy Financing. That's what that is. And HERO is just one of the specific forms of that, just so you guys know. And it is collected through the taxes. It's shown in the exact same place where Tommy showed you the other one. It's usually in red, so it shows you that it is definitely only going to last for so much time. And just like Tommy showed you that you can find out when it's done, you can do the same thing. You can take that, you can copy that middle section, go to HERO, put in that code number, and it'll tell you how much longer it has. Again,
it'll always say PACE or HERO.
Yeah, or both.
It'll show there, and you'll know it is some type of lease finance against the property tax.
Right.
It always 100% says PACE or HERO.
Daryl, did you have a question? You have to unmute him, Tommy. Daryl, he has a question.
All right, give me a sec here. Yes, Daryl.
So on a property we closed maybe a year and a half ago, can't remember the address, but there was a PACE for the energy efficiency, and then there was a HERO for the solar. The HERO for the solar could be assumed, but the PACE could not be assumed.
Yeah, and that was actually a year and a half ago. Right now, HERO is not allowing them to assume them.
Okay.
As far as I know, yeah. So we're having some more difficulties with the HERO than we were before.
Now, is that driven more from the lending side and not so much from the HERO side, though?
That's correct. That is correct.
Thank you.
Yeah. Mm-hmm. Okay, so that's two very common that we see all the time: the Mello-Roos and the PACE or HERO. If there's no more questions, let's move on to supplemental bills. Okay, supplemental bills can be, you're going to see a supplemental bill almost all the time when you purchase a home. When someone buys a home, there's going to be a bill that comes out that is the difference from what the seller was paying on the taxes to now what the new value is going to be based on. Okay, so their buyer's going to be paying taxes on their new value. And 9 out of 10 times the value goes up, so you're going to see a supplemental bill, an additional bill for that increase. That's what the supplements are. The reason I wanted to talk more about these is supplemental bills can be secured liens or they can be unsecured. So the secured part of it would be that it's against the real estate. It's a tax that's implemented because of the real estate, because of the sales price, basically a sales price change, a value change. You can also get a supplemental bill for construction. So if you've done work to the property and increased the value, they can get you a supplemental bill for that. But an unsecured type of tax lien is basically, or an unsecured supplement, just starting supplement, can be an amount that is now put on you as an individual versus the property. And I kind of went into more detail on that so that you could see what that can be for. Tommy, go down to the unsecured property tax liens.
Real quick, before we get down to that,
Uh-huh.
let's emphasize how a supplemental bill is derived, right? So somebody owned a house for the last 10 years and the current assessed value on that house is $400,000. They sell their house and they sell it for $535,000. And what happens is that triggers a reassessment. Now, it doesn't happen right away, but it is going to happen within that first year. And it will reassess at the new sales price, right? So it's going to reassess at that $535,000. Now, sometimes I've seen them a little bit lower based on the houses around it, but ultimately it's going to trigger a reassessment. So whatever the new assessment is versus the old assessment, let's say it was $200,000, then that bill is derived by the basic levy, which is Prop 13's 1.13% to round it. And that triggers what that bill is going to be, the difference, right? Over a duration. So then that is a separate bill that does not show on your normal tax bill. So you're going to get your normal tax bill and it's just going to show, here's what your normal tax is. But you're going to have a secondary bill, which is an assessment bill, a reassessment bill, right? And that additional dollar amount needs to be paid even though your tax dollar amount has changed in your normal bill, because that's the difference between when you bought it and when it reassessed, right? So let's make sure everybody understands that. And it almost happens all the time. I have seen it where it hasn't, right? Here's where it's not going to. When somebody's assessed value is, say, $489,000 and they sell it for $495,000, right? That may not trigger a reassessment because the assessment's already high enough in the area, but it doesn't happen too often.
Well, and just so you guys know, I just saw this probably about 2 months ago. We actually had a supplemental bill. I had someone send it to me and it was zero. They had a supplemental bill and it said amount due $0. And so I had to call the tax assessor and say, I'm sorry, why'd you send a bill out that was $0? And they sent the bill out specifically just to show that there was a change in the ownership, so that it had the new names and the transfer date and everything. But they showed that they were not increasing the value at all because of, just like Tommy said, the sales price only changed by about, I think it was like 3,500 or 4,000. It was just a very less than 10,000.
Well,
so for what they bought it for.
Yeah, with Prop 13, it comes with regulations of how much property taxes can be raised, per year, right?
Right.
And so if it falls within that parameter, there is no reassessment because they can't raise it again already, meaning it probably reassessed within the last 2 years and they can't do another reassessment on it because it's less than that 1% or 2%, whatever it is, right? I think it's 2%. Right. So sometimes it does happen. What people need to realize is that when you buy a house or even refinance a house, or if you if you do anything of nominal value that you had to pull permits for, a pool, right? A room addition, something like that, where the valuation is supposedly supposed to raise the property values a substantial amount. when you finalize your permits with the city, it can re-trigger a reassessment, right?
Absolutely.
It doesn't always, but it can. And the other thing that you had mentioned, Andy, that brings me up to a question is, I get questions a lot where the tax bill comes, somebody bought a house and the tax bill comes and it has the old owner's name on it, right?
Right.
Tax bills only update once a year. Once a year. And that is July 1st. So if you bought your house, let's just say that you bought your house in, I don't know, November, right? And then all of a sudden you got your next tax bill, or let's say you bought it in September and you get your next tax bill and you own the house for a few months and all, and then it still says the past owner's name on it. That is your tax bill, right? It's not going to change your name on that tax bill or any of the data or anything until that July 1st tax bill. That's when your name will then appear on it, because they only update those once a year.
Right. A lot of times you'll actually see two bills too. Let's say we closed escrow. Let's say we closed escrow. Let's just say we closed escrow today. So we closed a file today. So you're going to have to pay from today until July 1st, whatever the increased value is. So when they reassess it, they're going to put a value on they're going to determine what your new tax bill will be. They will then calculate a bill from today to July 1st or through June 30th. And then you will actually get a second bill from July 1st to possibly December or maybe even January. So
Right.
they will actually possibly give you two different bills, one for this year, which this year is 1920 tax year, and the next year is 2021 tax year. So people will call me all the time and say, I got a bill that's like $40 and then another one that's like 1,000. And then I have to explain to them that's for the portion of last year and then the portion of this year. So that's why it's a smaller amount, but that's what they're doing. And it just depends on when you close escrow in the year.
Right. All right, cool. I didn't want to skip over that because those are questions that I tend to get a lot of, you know. So I wanted to make sure that we covered that pretty well before we move down to the unsecured stuff.
Okay, so unsecured taxes, they basically are the only way you're going to have unsecured property tax is, let's say, this happens a lot with investors, by the way. Let's say they bought a piece of property and they flip it within their 90 days, okay, or maybe just after the 90 days. And so now they're going to have, they're supposed to pay a tax, a very small increase for those 30, 60, 90, 120 days. But they've sold the property before the tax assessor has even reassessed it, okay? Well, at that moment, when that happens, that tax now becomes an unsecured tax lien. It becomes a lien that is against the individual, not the property. So the new buyer does not have to pay that small tax lien. The investor that flipped it has to pay that. And so then they will get an unsecured tax lien. Those come out quite often. And I mean, I see them all the time for these type of flips when they're doing those, because I deal with investors so much. And when they come up, they're shown on the preliminary title report, just like the property taxes. It just shows as a separate item, and it says an unsecured property tax lien, and that's what those are. And so then those are paid through escrow from title. Again, so we take care of that. There's also unsecured personal taxes. Those are different than unsecured property. Unsecured personal are ones that are, let's say maybe you have a tax for boats, jet skis, airplanes, business transaction, like you own a business and there's a type of tax lien. Those are considered unsecured personal tax liens, okay? So they're different than the property. They're not from a property necessarily. They're from some other type of asset that you have. And I just wanted to make sure that everybody understood the difference between those.
We run across it most commonly on businesses,
Mhm.
right?
Yes.
Than anything.
Actually, I see a lot of boats and jet skis too, though, that'll show up. Because if you're delinquent, then they become a tax lien. It's an unsecured personal tax lien. It means you didn't pay, you know, how you're supposed to pay every year a certain tax for
Right.
those. So if you don't, then they go against you as an individual versus being against the property. You guys have any questions?
Yeah, let's open it back up for questions, because we didn't, you know, that's a good portion of covering the tax. I would say is let's hit on this before we open it up. Now that Realist has changed the information in which they give the agents online, right? I think we should cover how to calculate property taxes.
You mean as far as when they calculate the new amount?
Right. So if you're not on my site, or you don't have access to it, or you're out and about and you don't want to, you're having issues, whatever, so you can get access to my site on the go as well.
So now
But
let's
talk
let's talk a little bit about so if we're going to do that, let's talk a little bit about the lenders and how they do it. Okay, because remember, if you have an impound account, which means that they're impounding your taxes, and the lender's going to pay your taxes twice a year, and you're going to pay them through your payment every single month. People always ask me, but that doesn't make any sense. That's not the amount that's showing for the taxes, because the lender bases their tax percentage. The taxes, let's say the taxes are actually calculated on 1.14%. The lender will actually use a 1.24% or 1.25 when they calculate it, when they're estimating what those taxes are going to be. So they don't actually use the exact one that might be coming out of the tax assessor's office for that county or for that area.
Correct. And some people think, like, for instance, on this tax sheet right here, you know, I plugged in 5.85%. It gives a new tax rate 1.54. Now, yes, that includes all special assessments, right? But ultimately, to understand how to calculate what the tax is, right, is you're going to take the assessed value, so the current assessed value of the property. If you are looking at a home that's being purchased from your buyers, you're going to look at the sales price, right?
Mm-hmm.
If it is somebody who's already in the home and they're trying to calculate what their tax should be, it would be the assessed value. But for this, we're going to say it's a sales price of $585, right? We're going to take that $585,000, times it by the basic levy Prop 13 mandate, which I always tell people to use 1.13 or 1.14, right? Because it's actually a series of numbers, and you can round it either way because it's right in the middle. And it should give you something very similar to this, right? So ultimately, if I took that 585,000 times 1.13%, that gives me, excuse me, 585. Well, for this one, let me use this. Total improved value, 523. I'm going to use this because that way it'll calculate to those numbers. So 523,078 times 1.13%, that gives me, it's actually a little high, 59. It could be based on this 435, but it gives me 59, right? But you want to take your prop mandate and whatever that percent is, 1.13, whatever you're using, times the assessment or the sales price, that gives you a dollar amount. So let's say the dollar amount was this $51.60, right? That's your base tax. Then you have to take all of these added up and add it to the base tax to get the total tax that it's going to be, right? A lot of times I get calls because it's way, way, way high. And they're like, did I do this right? And a lot of people are taking this total amount and then timesing it towards the property value. and then you end up with like, you know, a 3% tax.
Right.
And so again, you have to take the value of the property, whatever that value is going to be, times it by the Prop 13 mandate, get that dollar amount, and then add all your other special assessments to it. Because the special assessments here do not ever change based on the sales price of the home. So all this stuff here that's highlighted remains that price. It doesn't change based on the sale price of the home, where the basic levy does, right? But all of this remains stagnant. The only time this changes is when they come in and say flood control for Santa Ana is going to go up to $4, and it changes for everybody, right? Other than that, it remains stagnant. So you want to take that and add it to what your basic tax is based on the sales price, okay?
Now you know what else we need to make sure everybody is aware of is that supplemental taxes, if you have an impound account, the lender does not pay the supplemental taxes. First of all, they don't even get the bill, so they don't even
Correct.
know about it. So you have to remember that they may have included, when they collected though, enough money to pay it, to cover it. It just depends on if they have enough in the account. So when you get your supplemental tax bill, you need to contact the lender to see if it can be covered through the impound account, or if you have to pay it yourself.
And most lenders are going to tell you no.
Yeah,
You
many
can't.
of them.
You have to pay it. You have to pay it. Now, don't get me wrong. I've had incidences where a lot of times the impound accounts are estimated high, right?
They are.
So by the time the tax bill comes, you've been in your house, you know, 8-9 months, and they've already made, in some cases, one of your payments for your taxes for the first or second half, and they've made one of your payments if it's on a 6-month for your insurance, and they can see what the overage is for your impound account by that point. So I've had some people where they have looked at it and been like, I don't know how I'm going to pay this. And then all of a sudden they talk with the lender, and the lender goes, oh, well, we can lower your impounds because right now you're paying X and you have a substantial overage, right? So they readjust them, and then they end up getting a check back from their impound account, and they're also saving every month that they have to make on that payment. So that is always a possibility sometimes, but your lender will never know about that. And that brings up a good point. For the agents should be coaching their clients at closing that, hey, it is possible that you will get a reassessment bill within the next 12 months. Mm-hmm. Make sure you open your tax bills. A lot of homeowners don't open their tax bills because they know it's paid through their impound account. Mm-hmm. So they really don't pay attention to it. Open them, because you will more than likely get a reassessment, and you will have to pay that. It's not going to be the full tax amount that your lender is going to pay, but it is going to be a supplemental bill that can range from, $100 on the low end to $1,000. It really depends on how much that property reassessed for in the difference of what it was. So it's important to make sure that they're opening those, right, and looking for them. Because there's nothing worse than like a year down the road, 2 years down the road, and there's still an assessment in there, and you're getting delinquent assessment bills, and they're charging interest to them. So you don't want to fall into that trap and be like, well, it was really my fault because I didn't open it, right? But I would say is I do get quite a few calls even from agents, newer agents, that say, hey, my client that closed on this property 12 months ago just got a separate bill. And yeah, I even have seen one when it reassessed before the name changed on the actual property tax bill, and it said the old owner's name on it. That means the name on it means nothing. The dates and the property mean everything. So when you look at what date it's for, if it was a date in which you own the property, that belongs to you regardless of whose name's on it. But I've gotten that one as well, where they're like, well, this bill has the old owner's name on it. Yeah, it's for that property though, and it belongs to that time frame. So you have to, look at that. And I have to instruct them that, listen, the name's not going to change until July 1st. And then they're like, oh, okay.
All right. I think we covered it all. No questions?
No, man,
Everybody's
let's open it up. Daryl, you got questions, man. Give me some questions.
good?
Okay, so I'm going back to the tax sale.
Okay.
Okay.
So the redemption period, I know it used to be 5 years, now it's 1. But I ran across a situation where the redemption period, the property was sold to a government entity, and there was no redemption period.
So that means the government entity went in and just actually paid the taxes current and took the property over?
Correct.
Yeah, that I've heard of that actually a lot happening in just the last couple of years.
Yeah.
I would love to talk to you more to find out what area that was, because I think it actually is more particular to certain areas. So maybe Daryl, you and I can talk and just let me know where that was. I'm actually finding that it seems to be specific areas.
Yeah, it's where we've been operating the last 3 years.
Ah, okay, yeah.
Now, Daryl, you said it used to be 5 years. Now it's 1.
Yes.
Well, that's not, I've just read in it, they said it's still 5 years. Did that change?
Well, for land, so those
Oh.
9 parcels that we just tried to
Oh.
refinance.
Okay, yeah,
Those
land is
were
different. Yeah,
tax
okay,
sales.
yeah.
So land is 1 year, residential homes are 5,
5
and commercial non-residential is 3.
is 3, right.
All right. Got some
Okay,
investment ideas going in my head.
uh-oh. He knows where to go now. You guys should check the other states too, because I have been checking out some of the other states and theirs are completely different. Sometimes after 1 year, that's it. Their state puts it up for auction and that's it.
Wow.
There's some states that they're not as lenient as we are here.
Okay, so Daryl, I don't know if I really heard your question though.
Yeah, I just wanted to just clarify the government right of redemption, which is like the water district came in and bought up a few parcels from some of our friends up there.
Mm-hmm.
And, you know, the mindset of people that own the parcels 10, 15, 20, 30, 40 years is, well, I'll just let it go to tax sale and come back in, you know, within a year and exercise my right of redemption. But one guy got caught with his thumb in a dike, so to speak, because the water district bought it.
So he didn't get it back. Yeah, oops.
Oops.
Okay.
So I'm just wondering if, you know, you've heard of any other areas that are like that, because we're branching out. I
haven't personally, no.
No, only, well, yes, I have actually in, what's it called? Fullerton, I think they were saying there was some where they did that also. I'll have to double check, but there was definitely a couple in, like above LA and a little bit east of LA, northeast of LA. So yeah, there were some areas that people were telling me that they were going in and actually bringing the taxes current and taking them. But those were actually, they weren't vacant land. They were actually homes. You know, they were actually after 5 years. One of them was actually 9 years, and they paid all the taxes current and then went ahead and bought it up. So, but I would think it'd be similar to, like Tommy, like you said, can you just go down there and say, okay, it's been this many years, it's past the 5 years, let's go ahead and put a bid on it. And Daryl, when you were saying redemption, you mean like after it's purchased, the actual owner has the right to come back after a year?
That's correct.
Yes, that's what you mean. That's actually on all of the properties. They're all the same. It's all 1 year.
And then let's be clear, because I've seen properties where there's been a loan on the property, an old loan, a really old loan that's been there in play, and there was no impounds. So they pay their taxes separately and everything else. And then the lender not pay attention to the fact that the property taxes are delinquent as well, where all of a sudden property taxes are delinquent, they're making payments on the loan, and that's in clean, but there's issues with the taxes. Those ones end up being brought to the lender first. So the lender holds the note on that property. So then you're kind of in a situation. I've gotten a couple investors that have come my way that you would ask me that, like, hey, this house has been delinquent for X amount of time. You know, where can I get information on swooping it up? And I'm like, I show a current loan on the property. You know, so you got to look at that as well. Usually when taxes are delinquent, they're either paid off, right? Because if a lender is not getting paid, they know the taxes aren't getting paid if there's impounds. So the lender just starts the foreclosure process before it ever gets to a scenario where there's going to be a tax sale.
Well, and even if they don't have impounds, they usually do that tax service where the service will actually notify them if the taxes are delinquent immediately within, just a couple months.
Correct.
So the lenders are usually notified right away if the taxes
So
are delinquent.
I ran into
from
one
them.
about 4 months ago that was 3 years tax delinquent. But when they approached them, it was from a wholesaler. The loan was still in play and it was still good. It had been on the property for 25 years.
Wow.
So
Well, I don't want to be a question mark. This is my last question. So the one that I sent yesterday for LA County has the HERO program on it. So what if the taxes are delinquent? How does HERO get paid if they foreclose?
they don't.
Well, they don't. Yeah, they're actually, if they're delinquent, then the HERO's delinquent also. So that would mean that if there's a buyer coming in, that those taxes, before we can actually close the transaction, they're going to need to go ahead and make sure everything is paid before we can close and transfer it.
That HERO is rolled into the tax. So when the taxes are paid in full and brought clean, then HERO's getting their money.
Right.
They're a line value in there.
Yeah, but I made an offer on a property in Lancaster about a year ago, and the bank refused to pay off the HERO. That was the buyer cost. And at that time, it was like $52,000.
Mhm.
And that's why we lost the deal because, of course, the buyer says, no way in heck am I paying the seller's delinquent HERO taxes. and HERO did not remove that $8,000.
Yeah, they want their money.
Well, they don't have to now. Yeah. It's like a lien. It's like a debt. So they don't have to. And like I said, they're not as easygoing as they were a few years back, where they would just allow anybody to assume them.
Wow.
Yeah, absolutely. Brenda had a question. Let's unmute Brenda.
I wanted to ask, this is back to the supplemental tax bill. If the seller paid the taxes ahead of time and it closes, and usually at closing, as you make those adjustments and you credit the seller back what they paid ahead, and then you bill it to the new owner, are they being billed the previous assessed values taxes? I mean, the tax assessment?
Yes.
Taxes are always
when
paid in advance. So
right. So when the prorations are done, the prorations are charged to the buyer based on whatever the tax is at that time, because the buyer only has to pay based on what the tax amount is. So in other words, they only have to give back the seller what they paid, not what the future amount's going to be.
Oh, okay. All this time I thought like we would calculate it based on what the new taxes would be for our clients. So I thought that you guys did the same thing.
Nope.
Oh.
Because the seller,
remember, their back half tax was $2,000, and let's just say it's right in the middle of that time frame. The current seller, the current owner, or the seller has already paid that $2,000, right?
Mm-hmm.
Well, let's say that the new buyers come in halfway through. Well, then the buyer would then pay from that point to the end, which is $1,000, and give that to the seller, right?
Yeah.
So the seller gets reimbursed what they've already paid based on what days they're not going to own that property. But the reassessment is going to re-trigger down the road from the day in which you bought it to when it reassessed, right?
Yeah.
And that has nothing to do with the past owners, everything to do with the new owners.
right.
Okay.
And Brenda, if you're thinking about, okay, so let's just take an example. Let's say that the new tax year starts July. let's say we close
Mhm.
on August 1st, right? The
Mhm.
taxes are not getting paid from July until January 1st. They're not getting paid until December, right? So those taxes are not going to be paid ahead of time. So then escrow is going to actually charge the seller from July 1st, and they're going to credit the buyer towards that bill that will be coming out in October or November, to be paid. So,
Mhm.
but keep in mind that bill is going to come out based on what the tax amount is, based on the seller's value, because they won't be basing it on the new amount yet. That's what the supplement will be. So the bill is going to
Oh,
be a
okay.
lower amount.
Okay. So they do
Okay.
their assessments after January.
Right. Right. So they're
Okay.
not going to be assessing it. Probably it might even be farther down than that. It could be actually maybe even June or July before they actually reassess it. So it just depends on when the assessment gets done, where it gets increased. And they don't get billed for that difference until those supplemental bills come out. So
Right.
until then, they're
Okay.
just paying based on what the seller's is.
Oh, okay. So I mean, I understand how you do it. I just didn't understand when. Okay.
Make sense?
Thank you.
Yeah, there's no hard date on when a reassessment will take place. So,
Yeah.
Yeah.
Daryl has another question.
what's up, Daryl?
So, for those agents that work with buyers, I don't anymore. We used to go in and calculate the new taxes a little higher because, especially if it's an out of county lender, their AUS system is defaulted for 1.25%.
Right.
Correct. Mhm.
And, when we give them the number and they're unfamiliar with Riverside or San Bernardino County taxes, it's usually a sticker shock.
Right. Yeah.
In which if the lender calculates at 1.25% and let's say the tax is 1.65% ultimately, then that could trigger not having enough going into the impound as well, right? Down the road, when all of a sudden it's in there, instead of having an overage in your impounds, you can have not enough in your impounds where then the lender reach out and says, we need to increase what we're billing you for your impound so your payment is going up to cover the difference. Hopefully that doesn't happen too often.
So like at this time of year, I know it was prudent, I used to work with a lot of VA buyers, is that Navy Fed would typically collect between 4 and 6 months impound reserves. And then, like if they were closing in November, just before the holidays, they would collect 1 month. So is there any type of matrix that would indicate, just a ballpark figure? I know it's lender specific of what impounds are typically collected during each month.
Well, I agree with you that most of them do go off of a 1.25%. The only thing you need to keep in mind, and sometimes the lenders, like Tommy just said, they'll miss the Mellow Ruse, or they'll miss, maybe a Hero or something that's in there that's going to be included. And so we, as escrow, will send them a copy of the tax roll, which shows them, okay, so if you take a 1.25, that's your base, but then you also need to include these additional amounts to your yearly total for when they're calculating their impounds. So they will actually ask for a copy of the tax roll, which breaks down those assessments that are added in. So most of the lenders I work with, that's what we do, is we give them those assessments, just like Tommy showed you. I give them a form that's just like that, and they take the 1.25 and then they add the assessments on top of it, and that's the yearly amount. And then they divide it by 12, and that's how they calculate what they're going to collect every month. Now, if you're asking if there's you could actually get a calendar that will show you from January to December what lenders, how many months they're going to collect each month. You can actually get a copy of that. I might even have one if you want me to send it to you, Daryl, so you can tell, depending on the month for the year, how many months they're going to collect in impounds.
Yes, ma'am. If you can send that to Karen and Brenda, please.
Sure, no
No
problem.
buyers for me.
Absolutely. No worries. Absolutely.
And also, Annie, typically what we do with the land, the tax search prior to closing, is that
Uh-huh.
something that you do with the residential buyers?
You mean as far as ordering that for you? That little
Yes.
tax? Yeah, we could probably do that. You want to do that on well, it depends on like for a specific property, right?
Yeah, because knowing this time of year we're going to get flooded with military buyers, I
I
just want
gotcha.
to bracket it into what the taxes are going to be. I don't know if it's if it's an extra step that you would have to do for the tax cert for the buyer reps from our team.
Oh
That would
no,
be a lot helpful.
it's just I mean, when I order these documents, like for instance, a lot of times the tax certificate or the tax roll I'm talking about, it comes out automatically in certain of the documents that we order. Like a property profile, it's going to be there automatically. Now, if you order a prelim, I have to order it in addition to. So it just depends on what we're ordering.
Okay, perfect.
Okay.
Perfect.
All right. Esther or Tatiana, do you guys have any questions in regards to taxes?
Or anything else. This is the open. You guys have a question?
Yeah, now would be the time to ask. I'm going to take silence as a no. If you do, by all means, you can reach out to us and we'll get those answered for you. Annie, go ahead and look at the notes. A couple people asked to have the deck emailed out to them, so we'll get that sent out to you today.
Okay.
And then, of course, this will be recorded as well, and I will send everybody the recording of it, just in case you want to go back and listen to it. All right. At that, we still need a topic for our next week's Zoom and Learn. So if anybody has a topic, by all means, send them our way. We basically pick these topics based off of agent feedback and questions that are being asked throughout the week. So if anybody has anything, by all means, let us know. We'd love to cover it on one of our Zooms. And I think we'll be moving back to the 12:30 timeframe next week. I had a conflict today that had me push it. And yeah, I think that's it. Annie, final thoughts?
No, I think we covered everything.
Thank you so much. Have a great day.
You too.
Bye.
Bye, guys.
Bye, guys.
Bye.
Thanks again.
Bye.